Trying to guess the next market crash or reacting after the news gets tense can crush your retirement. Hunkering down and giving up on growth isn't the answer either. The truth is, success in retirement doesn't come from guessing. It comes from knowing your plan is ready for the likes of 2008, 2020, and whatever is next. In this video, I'll show you the 3-step framework that helps retirees rest easy, knowing they don't have to watch the stock market every day. Let's jump in. So a new client getting ready to retire asked a really important question. How do we protect our investments when the market drops again? They weren't panicking, they just knew that volatility feels different when you're about to start drawing from your portfolio. And that's what most retirees care about. Not how to beat the market, but how to stay retired when it drops. Now, in order to properly answer that question, we first need to understand how the market actually behaves, because many people still misunderstand the patterns and frequencies of downturns. A 5% drop happens almost every year. A 10% correction, that's about every 2.5 years. And a full-blown bear market, a drop of 20% or more, shows up roughly once every 6 years. The smaller drops may not cause the same level of panic as a bear market, but they often lead people to react prematurely, fearing it's the start of something worse. And when markets do recover, that recovery doesn't always come quickly or when you need it most. Some of the worst bear markets in modern history took years to fully recover. 1973 to 74, and then again in 2000 to 2002, over 7 years. And 2007 to 2009, nearly 6 years. The average for a bear market from peak to peak is nearly 3 years. In the moment, that's a long time to wonder if things will get better and to worry about making the wrong move. And this is where many retirement plans fall short. They might account for volatility in a projection, but they don't give you clear guidance on what to actually do when that volatility shows up. So retirees often end up doing one of two things as I see it. They overreact, move to cash, delay spending, or even question the entire plan, or they underprepare, assuming they can ride it all out while still withdrawing from a shrinking portfolio. All this while feeling the weight of uncertainty and stressing over a costly mistake. See, a strong retirement plan doesn't try to avoid downturns, it's built to absorb them. You don't want to rely on gut instinct when things get rough. You want to have clarity before the market moves and a system that gives you the confidence to stay on track without guessing. And here's what most people miss. Before you decide how to invest, you need an adaptable plan for how you'll spend. And that income plan will inform your investment allocation. So how do we implement the 3-step plan to address that one big question? If the market drops, what should we actually do? That question came up a lot in 2008. I was working with retirees whose portfolios and home values were getting hammered. Some were understandably nervous. The news felt almost apocalyptic. Banks were failing, stocks were in a free fall, and it felt like nothing was safe. But instead of guessing, here's where it starts. We went back to their financial plans. They didn't need guarantees, they just needed clarity. Answers to those questions like, do we need to cut back? And if so, by how much? And that's where dynamic risk-based guardrails come in. See, guardrails take your retirement plan and turn it into a real-time decision system. They don't predict the future, but they help you respond to it. So here's how it works. So for this client of ours, their portfolio has just over $2 million with an initial spending level of $10,500 per month. And that does include some other income sources like Social Security. See, guardrails define a range for your portfolio value. So if your investments stay within that range, you can keep spending at your current level with confidence. But if your portfolio drops below the threshold, and in this case down to 1.38 million, their plan instructs them to reduce income by about $400 per month. It's not fun, but it's manageable. And most importantly, you're staying on track. On the other hand, if the markets surge, your portfolios grow, in this case to up to 2.5 million, your plan allows you to increase spending by $1,600 per month. So it gives them the permission to enjoy more without the guilt or the second guessing. And this helps prevent the common mistake of underspending as well. So now let's stress test it. What would have happened if they retired just before the 2008 financial crisis? Because that was a brutal downturn, but with guardrails in place, here's how the plan would have responded. So early on, their portfolio hits the lower guardrail. Their plan instructs them to tighten their belt by $400 per month, and then another $800 per month to stay aligned with their long-term goals. Now, in reality, you may absorb the hit, or by having a cash reserve in savings, this helps smooth out the drop in income. Then as the market recovers, their portfolio rebounds, and their plan here gives them the green light to increase income again. So if they want this time around $1,300 per month and then another $1,500 per month, they can increase. There's no guessing, no reacting to headlines, just following a system built to adapt as life unfolds. That's the power of dynamic guardrails. They give you structure instead of stress, confidence instead of guesswork. And that means you get to focus on living your life, not watching the market every day. Guardrails help answer the question, can we keep spending? But there's another piece that most retirees overlook. How do I position my investments in advance to align with my income needs? And then where does the money actually come from when we need it? Because even with a strong income plan, if you're forced to sell stocks when they're down 20, 30, or 40% just to fund your expenses, the damage can be permanent. This happening early in retirement just compounds that problem. That's what we call sequence of returns risk. It's not about your average return, it's about the order of those returns. So in this example, portfolio C had the same average return as portfolios A and B, but because the bad years came early, the withdrawals actually forced the portfolio to run out of money. That's the risk you face if you're withdrawing income while the markets are down. So to protect against that, we built something called a war chest. The war chest is your personal buffer. It's a way to segment your investments by time, not just risk, so you can weather downturns without derailing your plan. Cash can cover the next year of income, maybe 2 if you prefer. Bonds can support years 2 through 7, focusing on high quality, short to intermediate term holdings. Of course, you can extend that if you're more conservative. Stocks are there for the long-term growth, money you don't need for 5 to 10 plus years. If you're more aggressive, you might tap stocks as early as year 3. And if you're more conservative, you can stretch your stable income reserves to 10 years or more. This structure gives you flexibility. You draw from cash and bonds when markets are down, and then allow stocks to recover, so you're not forced to sell at the wrong time. That's how you reduce panic, avoid locking in losses, and give your growth portfolio the space to rebound. But the war chest is just the setup. Next, we need to talk about how to manage it, because without a system to refill those buckets, most people eventually run into trouble. But this simple step 3 of the framework can keep you on track. Not just when you start retirement, but as you move forward, taking income all while markets are moving potentially every which way. And the answer is a predetermined system to refill those buckets. There are a few ways you can set up your rebalancing. One of the simplest is calendar rebalancing, a once a year reset to your target percentages, no matter what the market is doing. The chart here from Michael Kitces shows that rebalancing more often than annually typically doesn't add much value. And if you're still working and contributing to a 401k, most platforms let you automate this process entirely. You set your target allocation once, choose annual rebalancing, and the system keeps you on track. Now with our clients, we use a strategy for rebalancing called tolerance bands. Kitces research shows that optimally, if an asset class moves 20% above or below its target, then we rebalance. So for example, if you have an investment with a target of 10%, we'll act if it drifts to 12% or drops to 8%. The goal for the tolerance bands is to set these thresholds far enough for the investments that have momentum to run, but not so far that they run to extremes and then bounce back again. The research shows this tolerance band method can actually enhance returns by up to 0.39% on average. This isn't about chasing performance, it's about rebalancing with discipline, because that discipline does something powerful. It buys stocks when they're low and trims them when they're high without second guessing or reacting emotionally. This keeps your war chest intact and ready for a severe and possibly prolonged stock downturn. And in that case, you might pause from rebalancing, use the stable assets for this intended purpose, and allow stocks to recover. And this is what beats that hunkering down approach of eliminating all the growth potential from the portfolio. Having this step in the framework prepared and working ahead of time gets you ready for both the ups and the downs. Now, we've covered how to invest in retirement, how to prepare for those inevitable downturns without hunkering down and giving up your growth. But here's the thing. A lot of people come to us and say, my advisor, they talk about the investments, but they've never even asked for a copy of my tax return. If your plan isn't coordinating where you take income and how to minimize taxes, you could be giving up thousands every year without realizing it. That's why the next video you need to watch is the perfect retirement tax plan. It's a step-by-step guide to keeping more of what you earn and making your retirement income go further. Check that out here. And if you'd like help coordinating your tax-efficient retirement portfolio, coordinated for your income needs, I've added a link in the description to schedule a brief call. Thanks for watching.